Hi, and welcome to this short lecture video on gross profit and gross profit margin percentage as part of Stratfield Solutions Understand Accounting in 5 Minutes series. Today we're going to be looking at the gross profit and gross profit margin percentage, which are two indicators of business profitability, and they're used widely across both financial and managerial accounting applications. So first, what is gross profit? Well, as mentioned, gross profit is considered one of the most essential metrics of business success. There are very few companies out there that don't have a gross profit or a substantial gross profit margin, which we'll talk about in a minute. And what this does is it analyzes the business's selling price or revenue minus or less the cost directly associated with making that revenue. So it doesn't include all of the expenses of the business, but it does include the most essential or the most significant, which are the costs directly associated with making a product or delivering a service. The costs directly associated with this are referred to as COGS, cost of goods sold. You'll see that abbreviated as COGS or pronounced as COGS, C-O-G-S. The goods could refer to physical units, or they could be the direct cost of services provided if it was a service firm. And gross profit can be expressed as a total dollar measure, so in total number of dollars of gross profit, or more commonly, it's as a percentage called gross margin or gross profit percentage. You'll hear those two terms interchangeably. So what is the gross profit margin percentage? Well, the gross profit margin shows the difference between the revenue earned and the cost of goods sold, but here we look at it as a percentage. So instead of looking at total dollars, we look at a percentage metric. So for example, and we'll go through the calculation steps in a separate slide, but as an example, revenue would be $100, cost of goods sold is $40. We take the difference between those two, 100 minus 40 gives us 60, and we divide it by the original revenue amount of 100, that would give us a profit margin of 60%, which is rather good for pretty much any industry. 60% would be a very good profit margin. So the profit margin is extremely helpful for a business to compare its product lines to one another. So we'd look at whether product line A was more profitable than product line B. You would use the profit margin to do that. And we can also use it to compare the performance of other competitors and how we did from one year to the next. So we can use a time measurement. And as mentioned before, sometimes this is called the gross profit percentage rather than the gross profit margin. So now back to the formulas. Gross profit is simply sales minus cost of goods sold, or COGS. And then the gross margin just adds one step to that. So again, the numerator is sales minus cost of goods sold, and you divide the result of that by sales. Okay, what would you use these for? Well, gross profit shows if the product or service is generating more revenue than the costs associated with it. If a business can't sell a good or service for more than it costs to make it, the firm's going to shut down that product line or that business. Now we can go into how contribution margin works and other managerial accounting techniques, but for the most part, if you're not going to be able to make a product for a profit, you probably are not going to continue to produce it. And a gross profit percentage can help business executives, like mentioned, compare product lines with different margins and how their business is doing versus the competition. Often the gross profit margin is compared year over year to determine optimal prices or impacted from changes in cost of goods sold. So how can I increase gross profit? Well, increasing gross profit or the profit percentage is a goal for many companies, but it can come at a cost. There's two methods to do this. You could increase the selling price of the unit, or you could decrease cost of goods sold. Well, typically firms can only increase their selling price so much before customers will no longer purchase the item, and then they would lower their quantity, overall reducing the amount of revenue. So it's a trade-off between higher prices and lower volume. And suppliers can only be stretched so far, and many have a minimum price point, restricting how far cost of goods sold can be pushed down. So you can't always get anything for free. So two quick practice problems to round this out. First one is to calculate gross profit in dollars and percentage of the following. ABC company had sales of $20,000 and associated cost of goods sold of $15,000. Well, for gross profit, it's pretty straightforward. Sales minus cost of goods sold, 20 minus 15,000, gives us a $5,000 gross profit. For the margin, again, the numerator is the same as the gross profit, 20,000 minus 15, divided by the sales of 20,000, gives us a 25% gross profit margin. Second problem, again, same type of fact pattern. ABC Company sold 25 units at $10 each. Associated cost of goods were $8 per unit. Gross profit, sales times the number of units sold, revenue times the number of units, minus the cost of goods sold, number of units times the COGS, gives us a $50 gross profit margin. Then again, that percentage, the numerator, sales minus cost of goods sold, and divide that by sales, you will get a gross margin of 20%. So a little bit lower than the previous problem. And that's really it. Gross profit and gross profit margin are extremely valuable concepts in running a business and in being able to compare results over time or from period to period. Hope you enjoyed this short video, and check us out at StraffieldSolutions.com for more content.